This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stocks plummet as trade tensions escalate, and investors wonder whether the strong fundamentals that drove this bull market are now under threat.
Risky business. Economists first dismissed those tariffs as a rounding error for the U.S. economy, but that may be changing.
A big change to the Dow. General Electric is out. Walgreens is in, changing the makeup of the oldest and most widely followed market indices. Those stories and more tonight on Nightly Business Report for Tuesday, June 19th. And good evening, everyone. I'm Contessa Brewer, in tonight for Sue Herrera.
And I'm Tyler Matheson, in for Bill Griffith. Well, all that trade war talk is starting to stick to stocks. Today, the Dow notched its longest losing streak in 15 months, down 6 in a row. Those gains for the year, out of here, gone. This after President Trump threatened to slap additional tariffs on hundreds of billions of dollars of Chinese goods, ratcheting up trade tensions between the U.S. and China. Investors held on tight as stocks dropped sharply, not just on Wall Street, but all across the globe. The Shanghai Composite Index fell to its lowest level in nearly 2 years. In Shenzhen, stocks fell about 6%. Meanwhile, the Dow down 287 points to 24,700 on the button. The Nasdaq dropped 21. The S&P was down 11. Boeing and Caterpillar, the two companies considered bellwethers for trade tensions, were the biggest losers on the blue chip Dow index. And as trade tensions escalate beyond expectations now, questions are being raised about the outlook for stocks. Bob Pisani starts us off tonight at the New York Stock Exchange.
Traders are facing an unpleasant reality. The main reason for the stock market rally, the record corporate earnings growth, thanks to the expanding global economy and tax cuts, may now be under a bit of a cloud. Earnings estimates have been going up in the third and fourth quarters, and the market is now worried that these numbers might be in danger thanks to the threat of a looming trade war. Stocks have held up very well this year because analysts have been consistently raising estimates for all quarters. All 4 quarters are expected to pass 20% earnings growth. That's huge. You don't get those kinds of numbers very often. The problem is sectors like energy and materials and industrials and technology, the most critical sectors when it comes to boosting earnings growth, just so happen to be the sectors most exposed to global trade and the stronger dollar. Given the sky-high estimates for earnings for the rest of the year and the exposure of these key sectors to the trade tariffs, it's little wonder that the market is starting to expect earnings cuts may be coming, even though analysts don't have any numbers to plug into their models yet. They just don't know. But the market's starting to get worried. Some strategists appear to be clinging to the hope that Trump's get tough policy on immigration and trade are designed to appeal to voters in the midterm election, and that with a strong economy, the president can afford to press this issue for a few months, even if the markets drop, and then compromise after the election. They believe it's significant that some of the tariffs will likely not take effect until after the midterm election, implying Trump's main objective may be to get to that point, and that he may relent soon after. But the stakes have definitely been raised. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, the Trump administration doubling down on its tariff strategy against China with a request for up to $400 billion in additional tariffs on Chinese goods. Kayla Tausche is in Washington tonight.
As the global trade battle intensifies, President Trump defended new tariffs, his weapon of choice to fight China's unfair trading practices.
We have to do something about it. Now, maybe something happens where they come and they say, we agree it's been unfair for the last 25 years. But somehow that doesn't seem to work so easily.
The tactic slapped new fees on Chinese goods coming into the U.S., first targeting $50 billion in products like dishwashers and aircraft parts. After China said it would retaliate, Trump targeting $200 billion more. And if China launches yet another counterpunch, and added $200 billion on top of that. The resulting policy would touch the majority of goods coming into the U.S. from China, which totaled $500 billion last year. By comparison, the U.S. sent $130 billion in goods to China, which is why White House trade hawk Peter Navarro, the proponent of this strategy, says China has more to lose. Goldman Sachs CEO Lloyd Blankfein says the tariffs may just be a negotiating tactic.
That's what you would do if you were crazy and really wanted to end free trade And that's what you would do if it was a negotiating position and you wanted to remind your negotiating counterparty of just how much firepower you had.
Investors worry China could move beyond the tit-for-tat on tariffs and limit U.S. business there or stop buying treasuries.
I think this is a slippery slope, and investors are keeping an eye on this, but this pure protectionism path is very, very dangerous.
One key pawn in this battle, Chinese phone maker ZTE banned from buying U.S. parts after sanctions violations. Trump wants to revive it to extract concessions from China. Lawmakers this week moved to put guardrails around Trump's ability to do that and say it's still a national security threat.
If we allow ZTE into this country, China and its government will use our phones to spy on each of us.
The White House will appeal to lawmakers tomorrow to stand down on ZTE. But even if they do, it's unclear how President Trump would use that leverage. There are no trade talks scheduled with the Chinese, but according to Navarro, the phone lines are open. For Nightly Business Report, I'm Kayla Tausche in Washington.
The Chinese government, meanwhile, accused the U.S. of blackmail and warned of swift retaliation to that tariff threat. Eunice Yoon picks up the story from Beijing.
China has described President Trump's tariffs as blackmailing. The Commerce Ministry said today that China would fight back firmly and is considering qualitative and quantitative measures. Now, those words have caught the attention of the American business community here because the fact of the matter is that China cannot match the U.S. on tariffs covering $200 billion worth of goods. That's because China only buys $130 billion worth of goods. So there are a lot of questions as to what China could do next to retaliate. Some of the business people I speak to say that they're worried about investigations or safety inspections, delayed license approvals to block expansions, and consumer boycotts. Now, despite the tough talk, there are Chinese who are worried about the impact of the U.S. tariffs on the Chinese economy. That was reflected in the stock markets today. Shanghai was down by 5% at one point. Shenzhen fell 6% before recovering, and Hong Kong lost 3%. One former Chinese official told me that he is worried about the impact of the U.S. tariffs because all the economic indicators are showing that the economy here is going to be weaker. The FAI, or fixed asset investment, is slowing down. There are problems in the property sector, and debt is rising. He also said that China still relies on exports more than the United States. But what China does have is political will. Just as President Trump might not want to appear weak to his supporters, President Xi Jinping will not want to look as though he's caving to international pressure. This is not a democracy, and there are a lot of levers that the government can pull. And that was hinted at in the state media today, with one state paper saying that the U.S. seems to have fooled itself, thinking China is running out of bullets in this ongoing trade war. The truth is, it argues, as long as the U.S. wants to fight it, China will not run out of bullets. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Some economists are now also concerned about the impact on the economy and the potential for this trade fight to leave economic scars. Steve Leisman looks further into this.
As the old saying goes, a few billion here, a few billion there, and pretty soon it starts to be real money. President Trump now going where economists feared most, escalating the trade disputes to a place where all the tariff threats can have measurable impacts on U.S. and global growth.
If you were to have $400 billion of tariffs executed, not just discussed, but actually executed, you're probably talking about 4/10 off of global GDP, which today is about 3.9 to 4%.
Add to that potential negative effects on sentiment and the added uncertainty, which are both weighing on stocks now.
Does it resolve itself by way of a negotiated outcome that allows both parties to walk away claiming some level of victory? Or is this something that we continue to have to deal with on a day-over-day basis, incurring tape bombs along the way that disallows equity investors from getting enthused about the underlying strong fundamental conditions that support corporate earnings?
With potential for new tariffs and retaliatory tariffs up to $400 billion, the impact will depend on the strength of the U.S. economy when those tariffs start to hit.
if the underlying economy wasn't doing as well, and if we didn't have the stimulus, both tax and budget deal, I think there'd be a lot more to worry about. The U.S. economy, I think, in the second half is going to accelerate as opposed to decelerate. So whatever pressures we face on the trade side, I think we are in a much better position to absorb it.
Most economists agree fairer trade from China would boost U.S. growth. There's just increasing doubt and growing concern about the costs of getting there. For Nightly Business Report, I'm Steve Leisman.
So at what point could these escalating trade tensions become a sizable headwind for the markets? Joining us now is Andres Garcia Amaya, founder and CEO of Zoe Financial. Andres, good to see you again. You heard probably the previous guest say that the tax and budget tailwinds more than offset in the short term whatever headwinds there are from trade. Do you agree with that?
I would agree. If we look at the most recent data coming from, for instance, retail sales, we saw some acceleration actually going into the second quarter. So the earlier comments, I think, make a lot of sense, which is, if anything, if this had happened maybe in January or February, it might have actually had a bigger impact in the overall markets. But going into that acceleration of the U.S. economy, I think it could cushion it up to now. If this does escalate, that could actually mean a little bit more volatility than we're seeing right now.
The expectation, Andres, has been for a strong second half of the year that Q3 and Q4 earnings would continue to show growth now. When you're looking at what the possibilities of a trade war do to that, is it going to temper those expectations?
That's a great question. And I do think that there is one more driver that affects earnings going into the second half, which is oil. Right? If you look at earnings and earnings expectations or earnings guidance going into the second half, energy stocks is where the biggest upgrades to earnings have come in. So I would keep an eye on oil. If oil continues to fall, that would, I think, actually even have a bigger impact in earnings for the second half than these trade tensions.
Why is oil coming down?
Well, for one, we have one catalyst coming up, which is the OPEC meeting in Vienna on Friday, right? So there's this expectations that OPEC might decide to actually increase production, right? Therefore, in essence, more supply of oil would affect oil prices. The other one is that the dollar has been appreciating, right? And there's a negative relationship between the dollar getting stronger and oil prices falling. So those are two of the major drivers. But let me put it this way. I think that's a bigger driver for the overall equity markets going forward than this trade tensions. If these trade tensions do escalate into a full-out trade war, that might be a different story, but we're not quite there yet.
So how are you advising your clients now to factor in the risk of a global trade war, the importance of oil into this equation?
I think that's a great question. And the best way to think about it is do not let headlines dictate your long-term investment strategy, because we don't know what's going to happen when it comes to trade. We don't know what's going to happen with oil. If I had to pick between those two, I think oil matters more. But either way, that is why you have a well-diversified portfolio, right? So that you don't have to actually know and have a crystal ball what's going to happen next.
Andres, thanks very much.
Thank you.
Good to see you. Andres Garcia Amaya with Zoe Financial.
And to another issue that's part of the national conversation today, immigration. The top two business lobbying groups came out against the White House's policy of separating immigrant children from their families after they cross the U.S.-Mexico border. In a blog post, the Chamber of Commerce said, "This is not who we are, and it must end now." The Business Roundtable, which represents CEOs, urged the administration to end the policy immediately, calling the practice cruel and contrary to American values.
And in a wide-ranging speech to small business owners, the president today asked Congress for a third option on immigration.
What I'm asking Congress to do is to give us a third option, which we have been requesting since last year, the legal authority to detain and promptly remove families together as a unit. We have to be able to do this.
Senate Majority Leader Mitch McConnell said the problem at the border needs to be fixed and that he expects the Senate would address it with a narrow bill, not a wider immigration reform measure.
Still ahead, some of the companies with the biggest exposure to China.
A big shakeup coming to the Dow. Walgreens will replace General Electric in the index prior to the open on Tuesday, the 26th. GE was an original member of the Dow back in 1896. The S&P and Dow Jones, which determines which companies are in or out of the Dow, said the decision that the economy has changed, and with consumer finance, healthcare, and tech companies becoming more prominent, while the relative importance of industrial companies is less. GE's low stock price was also a factor. Following the news, shares of GE fell in the extended hours, as you see there. Conversely, Walgreens jumped.
Well, here's a real wake up from Starbucks. The coffee retailer warned sales would come in weaker than expected, and the company plans to close stores. That sent the stock lower in initial after-hours trading. Kate Rogers joins us now with more details. Kate, what are you learning?
Hi, that's right, Contessa. Well, Starbucks CEO Kevin Johnson presenting at a conference this afternoon, and the company breaking quite a bit of news. First, lowering their comp store sales guidance for the third quarter of 2018 to 1% from 3% globally. During the presentation, Johnson said that shareholders, quote, deserve better, and added that he's determined to fix this. He also talked a lot about growth, with Howard Schultz stepping down as executive chairman next week. Starbucks announced it will be also closing 150 underperforming stores in its densely penetrated markets in 2019. This is up from a historical average of about 50 stores per year. Beyond that, the company announced it would be slowing its licensed store growth. Those are the stores you see in hotels and airports around the country. The company will also be hiring an outside consultant to make it more efficient and also to help it identify areas of opportunity and growth. They plan to return approximately $25 billion in cash to shareholders via buybacks and dividends through 2020. This is up $10 billion from their guidance in 2017, and they also approved a dividend of 36 cents per share, guys.
A lot of news.
A lot of
there,
news.
Kate. Yeah, for sure.
All right, Kate, thanks very much.
Thank you.
Appreciate it. Starbucks, just one of a number of companies with operations over in China. The semiconductor sector has the highest revenue exposure to China. Dominic Chu runs through the list of companies that do get a fair amount of revenue from the world's second largest economy.
The biggest companies in the world have become increasingly multinational over the years. Not every company reports in detail how much business it gets from different regions globally, but some do. And for those that actually break it down, China can play a huge role. Of the biggest industrial companies in the S&P 500, many get a large part of their sales from China. According to data from MSCI and FactSet, farm equipment maker Deere & Company gets around 8% of its total business from China. Construction and heavy machinery maker Caterpillar gets 9%. Aerospace giant Boeing has around 11%. Diversified industrial 3M gets 13%, and for water heater maker A.O. Smith, a third of its business comes from China. But it isn't just the industrials. Well-known consumer-oriented companies also have a lot of exposure. Take athletic apparel maker Nike, which gets 12% of its business from China. Jewelry chain Tiffany gets 13%. Coffee giant Starbucks 15%, and the same with fast food king McDonald's. Even Apple gets around 20% of total sales from the Greater China region. These are just some of the companies to watch if trade gets even more heated in the days, weeks, and months to come. For Nightly Business Report, I'm Dominic Chu.
A rough day for the automakers. Shares fell on those rising trade tensions, in part because China is the world's largest auto market and a very lucrative one for the sector. Phil LeBeau is at the Port of Charleston, which exports a large number of vehicles, especially, I understand, Phil, BMW. So how important is China to this port?
Oh, it's critical, Contessa. I'm standing in the middle of, I'd say, about 5,000 BMW SUVs. These are vehicles that are parked here. Tomorrow or the next couple of days, many of them will be loaded onto container ships and then sent off to China. If you look at the numbers in terms of vehicle exports to China from the United States, it has steadily increased over the last 10 years. About 267,000 were sent over there last year, and that number is expected to move a little bit higher this year. And you're primarily talking about BMW, Mercedes-Benz. You do have some from the big three as well, although a smaller number, and Tesla, which is also sending its vehicles built in Fremont, California, over to China, which is the largest and fastest growing electric vehicle market in the world.
You know, Phil, China has said it would lower its auto import tariffs. That was good news for companies like BMW. Yep. But with a trade war in the air, could that be under reconsideration?
It's already under reconsideration for certain vehicles. Here's an example. when the Trump administration said, you know, we've got about $200 billion in new tariffs that we are going to implement, immediately, and this was about a week and a half ago, China responded and said, okay, we're going to hit certain agricultural products, other products from the United States, and certain hybrid electric vehicles, which means certain Tesla models, custom-made Tesla models that are ordered from Chinese customers now will be at slapped with a 35% tariff as opposed to a 10% tariff. And that's the concern in the auto industry, Tyler, that some of these BMWs, maybe a month, 2 months from now, China could come back and say, you know what, let's move back to 25%, or let's move it even higher.
And Phil, Boeing also has a plant in North Charleston. So what would be the impact of a trade war there?
Yep. Well, Boeing, its biggest customer is China. If you look at markets, 202 of the Boeing commercial airplanes delivered last year went to China. That's about 26% of its annual deliveries last year. It has a little bit of a cushion in the fact that airlines order airplanes knowing that they're not going to be delivered for several years. So it's unlikely that Chinese airlines would cancel orders immediately. That said, China does have a reputation and a track record for saying, you know what, we're moving some of these orders over to Airbus, or any future orders could go over to Airbus. And that's why Boeing is sensitive to these trade tensions.
Phil LeBeau at the Port of Charleston. Thank you, Phil.
Well, Sarepta's gene therapy treatment shows promise, and that is where we begin tonight's market focus. Drug maker said 3 boys with Duchenne muscular dystrophy saw improvement after taking the experimental treatment for 3 months. While the trial is still in its early stages, Sarepta said the therapy helped grow a key protein that is missing in people with this disease.
What we need to do is take the results we have. We need to treat additional children, and we need to watch the children for a while. But this is potentially transformative. We give them this gene therapy that replaces that dystrophin, that shock absorber, and at least in these first 3 children, at 3 months, they're showing this amazing expression. So the shock absorber appears to be in the muscle, and it does, at least in early days, appears to be working.
Sarepta shares soared 36% to 143.93. And after the bell, FedEx said it shipped more packages at higher rates, and that helped overall earnings rise and top expectations. The delivery giant also gave strong guidance for the full year, though it does see earnings coming in just a little light. Shares were volatile after hours. They ended the regular session down 2% at 258.39. Meanwhile, the business software maker Oracle reported an increase in profits after the bell, saying growth in its cloud division helped overall results. Revenue also inching a little bit higher. Shares of Oracle initially higher in the extended session, but finished the regular day down fractionally at 46.27.
Lazy Boy also delivered an earnings beat after the bell. The furniture retailer said more customers made purchases in the quarter, resulting in growth across all divisions and higher same-store sales. For the full year, Lazy Boy said it expects consolidated sales to rise more than 4%. But shares were initially lower in after hours, ended the day up a fraction to 33.25. And preliminary results show that billionaire activist investor Carl Icahn now has full control over Sandridge Energy's board of directors. Icahn sought to control the board and sell the company earlier this year after he criticized management for missteps. Shares took off, rising 7% to 17.02.
Coming up, what's at stake for Apple as trade tensions with China rise?
Apple is the world's most valuable publicly traded company. It's also a stock that a lot of investors own, either outright or in a mutual fund or retirement account. And it could find itself in the crosshairs of the intensifying trade standoff. Josh Lipton explains.
Mainland China is critical to Apple's success and a very important part of its financial future. Analysts estimate the country accounts for about 15% of the company's total annual revenue. And Apple has vast manufacturing operations in China. Most iPhones are assembled there and then shipped around the world. Apple CEO Tim Cook has made China a priority, visiting the country, setting up R&D centers there, and making big investment in Chinese companies like ride-hailing giant Didi Xuxing. The New York Times reports that the Trump administration told Cook that it wouldn't place tariffs on iPhones, though just today, White House trade advisor Peter Navarro countered he had no knowledge of any such iPhone exemption. Regardless, Apple could get caught in the crossfire in other ways. Apple is now reportedly concerned that the Chinese government could cause delays in its supply chain in retaliation for the president's proposed tariffs. Some analysts who cover Apple, though, say they aren't too worried.
We've estimated probably 100 to 150 million of cost could increase, which would still be a rounding error for Apple. So it's not a cost perspective. The worry is from that supply chain perspective. As of now, I think it's more of a scary headline than a reality, but that's what investors are concerned about.
Analysts note a potential advantage for the iPhone maker in this trade fight. It sells a popular device in China, and its assembly employs a lot of people. More than 1 million Chinese work on some way on Apple products. For Nightly Business Report, I'm Josh Lipton, San Francisco.
And before we go, and maybe against our better judgment, here's another look at today's big declines on Wall Street. The Dow off 287 points. The Nasdaq dropped 21. The S&P 500 was down 11.
And that does it for Nightly Business Report for tonight. I'm Contessa Brewer. Thank you for watching.
And I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody. And we'll see you back here tomorrow night.